Hedge fund managers, CIOs, and nearly everyone involved in the money management business have one thing in common: a conflict of interest. As I'm about to break down for you, the finance world is littered with individuals whose sole purpose it is to make money for their clients and push out agendas that align with their interests. In today's video, we have to keep these thoughts in mind as we break down a potential 2022 inflationary storm by analyzing the words of Scott Minerd, CIO of Guggenheim Partners. You may have not heard of Scott, but he's part of a company whose lineage includes many prominent businessmen that got extremely rich in the 1800s. Somehow the Guggenheim family wealth continues to this day. Scott is the chief investment officer managing over $330 billion in assets. What makes him special enough to make a video about is the fact that he's one of the few finance leaders who openly advocates for the Fed to become more hawkish. Specifically, he wants to end QE. Now, you may not find this special, but this is incredibly rare and interesting because on the surface, this would go directly against the interests of his business. Ending QE or raising interest rates is the equivalent of begging for a recession. One other person that has done this is Bill Ackman, who literally gave the Federal Reserve a presentation on why they should raise rates. Now, as it turns out, we know exactly why he did this. It wasn't because he believed it was the right thing to do. Instead, he had what is an equivalent to a short position prior to that, so his investors and him were in a position to make massive profits if the Fed did indeed listen to him. Now, Scott says the following in a recent interview with Fox Business News. Take a listen to his specific take.
Federal Reserve, do you think Jay Powell's reappointment, does that liberate him? Or are they going to put four left-wing, woke, climate change, diversity, equity people to stop him? I mean, he really ought to stop QE, shouldn't he?
Right. Well, look, QE needs to come to an end as fast as we can. And by the way, I think the market already is expecting that they're going to be aggressive. Now, the history, of course, is the Fed has a history of fighting the last war, right? And so, I think getting QE to end quickly is important. Making a decision about raising rates, I think we've got to watch the economy. We've got to watch inflation. Because a lot of the inflation we're seeing is coming from the goods side of the equation at this point, not services yet. And a lot of the stuff on the goods side, Larry, whether it's chips or it's energy or, whatever the inputs are, as you know, these are things that in the short run, as prices drive higher, it'll increase supplies. And so I think ultimately, we'll see this abate and reverse itself.
So there is Minerd stating the obvious. Everyone knows that the way you're supposed to fix inflation is to raise the interest rates and stop QE. But as we've talked about on this channel before, the Federal Reserve seems to have lost control over this function as it's kept interest rates at essentially zero for the past 15 years. Thankfully, they never ran into significant inflation until now. But there's a problem. Every time they have tried to raise the rate, the economy ended up falling apart. This was evident in 2018 with just a couple of small bumps. Now with inflation out of control, the Fed has made it clear it will attempt to raise the rate just 0.75% in hopes to tamper prices. But as we saw earlier this week, the market is having none of it. So that begs the question, will the Fed actually go through with their plans of tapering? What will Jerome Powell do if the S&P all of a sudden takes a nosedive because of his actions? Will he choose inflation or an economic crash? The latest report was horrifically hawkish, and we saw many stocks taking a nosedive this week in fears that Jay Powell may actually do the unthinkable. Take a listen to Meet Kevin say exactly this.
Hey everyone, Meet Kevin here. This video is brought to you by Masterworks, but more on them in a moment. Holy smokes. This is by far the worst report from the Federal Reserve I have seen in a very long time. Everything converged into this report for what I call peak doo-doo.
Many, including Peter Schiff, firmly believe he will continue to party and go back to the printer for help. Now, eventually, we all know this will spell disaster, and logically it makes sense to feel the pain now rather than death later. But this solution goes against the interests of the elite. They would much rather inflate the dollar than crash the economy. This includes hedge fund managers who have a direct interest in keeping the stock market moving forward. There's a reason why super yacht sales are at an all-time high, and the divide between the 0.1% and the rest of the world grows further and further apart. It's also why Scott calling for the end of QE is highly suspicious. There's no reason for him to do so unless he has a position that stands to profit from this. By the way, this isn't me questioning the character of Mr. Minerd, it's simply an observation that nobody in that position of power would ever comment something like that unless it stands to benefit them. The The money supply is at an all-time high and continues to push forward. The federal balance sheet, which is a great stat that correlates with QE, is also at an all-time high. Inflation, whichever way you measure it, CPI, WPI, RPI, it's all record-breaking. The Federal Reserve is working overtime to keep the world economy going, and soon it will face the ultimate choice. Go back to the norm of printing money and artificially pushing the economy forward, or raise rates, end QE, and start a recession, potentially a depression, in order to move forward, saving the US dollar. If you think the choice is the former, don't hesitate to buy the dip on the Public app. My affiliate link is in the description below. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed.